So, um, I want you to imagine a friend of yours just bought a brand new car.
Oh, like a really nice one, fresh off the lot.
Exactly. Fresh off the lot, pristine paint job, the whole deal. Now, for the first few days, before their full comprehensive insurance coverage is officially kicked in, just watch how they behave in a grocery store parking lot.
Right, it's total panic.
It is a masterclass in human anxiety. I mean, they will bypass 20 open spots near the entrance.
Yeah.
Right, just to park a mile away in the absolute most desolate corner of the lot.
Oh yeah, just to avoid like any rogue shopping carts.
Yes. They are hypervigilant. They're checking their mirrors 3 times. They look over their shoulder. They practically wrap the car in bubble wrap.
Because they're basically acting as their own personal risk manager at that point.
Yeah.
At that specific moment in time, the financial consequences of a scratch or a dent or, a shattered taillight, that is entirely on their shoulders.
It's their money.
Exactly. The threat to their wallet is direct, and it is completely unmitigated.
But then, fast forward to the day the insurance policy actually goes into effect. Like, you go to the store with them a week later, and that hypervigilance, it just vanishes into thin air.
Gone.
Totally gone. They are sliding that pristine car into the tightest, most chaotic spot right next to the cart return corral.
Right in the danger zone.
Yeah, right where people are squeezing past with strollers and carts are rattling by, and your friend is just completely unbothered. And if you point it out to them, they just shrug and say, whatever, insurance will cover it.
And that right there, that is a profound psychological shift. And honestly, that shift is the entire reason we're here today.
It's a huge concept.
It really is. So for anyone joining this deep dive, whether you're like a CPCU student grinding through your coursework or a seasoned professional in the risk industry, or even just someone who's intensely curious about the hidden forces driving human behavior, this single concept is the invisible engine of the insurance world.
The invisible engine, like that.
Yeah, I mean, our mission today is to unpack how the very existence of a safety net fundamentally alters human incentives. And, how a multi-trillion-dollar global industry is engineered from the ground up to counteract the behavioral changes it basically creates.
Right. And we're talking about moral hazard.
We are.
And I got to say, the first time I encountered that term, I thought we were about to dive into this heavy philosophical debate.
Oh.
Because the word moral, it just carries an enormous amount of baggage, right?
Oh, totally. People hear that and immediately think it's a character judgment.
Exactly. It triggers thoughts of right and wrong or good and evil. It sounds like a really harsh judgment on someone's soul, almost as if the insured person is this villain who's actively plotting to cheat the system.
That reaction is incredibly common, actually, and it's the very first misconception we need to dismantle here.
Okay, let's dismantle it.
So in the broad economic sense and in the insurance sense, moral hazard is not a referendum on a person's soul. It's really not about being malicious or having a flawed character. It is purely and mathematically about a shift in incentives.
A shift in incentives.
Yeah, because economics teaches us that human beings are, rational actors, right? We respond to the incentives placed in front of us.
Right. The environment dictates the behavior.
Exactly. So when you place a financial safety net beneath someone, the basic biological survival-driven incentive to be hyper-vigilant naturally decreases.
So it's not that my friend with the new car suddenly became a bad person overnight.
Not at all.
It's just that the calculus of their daily decisions changed. Like, the penalty for being careless was outsourced to a giant corporation.
The penalty was transferred.
Yeah.
Yes, exactly.
Yeah.
There's actually this phrase in some of the source materials that captures the psychological trigger perfectly. Translated into English, the mindset behind moral hazard is basically just summarized as insurance will pay anyway.
Insurance will pay anyway.
I mean,
Man, that is so insidious, but it's so accurate.
it really is.
Because it's not some villainous monologue you're having with yourself. It's just this quiet little whisper in the back of your mind when you decide not to double check the lock on the front door.
Right. It's the subconscious acknowledgement of the safety net. Let's actually apply this to the smartphone example from the text. I think this scales the concept down to something we all hold in our hands every single day.
Oh yeah, the phone example is great.
So think about the afternoon you purchase a $1,000 smartphone.
Oh, I treat it like a Fabergé egg.
Right.
Like, it does not leave my hand. I won't set it near the edge of a table. I'm practically holding my breath when I walk over concrete.
Exactly. And why is that?
Because I'm bearing 100% of the financial risk of dropping it. If it breaks, I'm out $1,000.
Your incentives in that moment are perfectly aligned with loss prevention. But then think about the exact moment you purchased the comprehensive phone insurance plan. The one covering accidental damage, cracked screens, water damage, all of it.
Yeah, the behavior shifts almost immediately.
How so?
Well, I start tossing it onto the couch from across the room. I let my toddler play with it over a tile floor. The whole insurance will pay anyway and mindset just completely takes over.
And that behavioral change, the physical act of tossing it onto the couch, it quantifiably increases the probability of a loss occurring.
Wow. Yeah, it really does.
That is moral hazard in action at a micro level. I mean, the insurance policy didn't break your phone, but the policy created the exact environment where you felt comfortable taking the risk that eventually broke the phone.
That makes perfect sense. Now, the sources also scale this up to a macro level, specifically looking at property insurance. There's this classic example regarding roof maintenance that highlights a totally different dimension of this concept.
Oh, the roof example. Yeah, that one is foundational for property underwriters.
Walk us through it.
So imagine a homeowner who, for whatever reason, does not have homeowners insurance. Okay. If they're up on a ladder cleaning their gutters and they happen to notice a small leak or maybe a few curling shingles, they are going to drive to the hardware store and fix it that very afternoon.
Because they know that if a severe rainstorm hits, that small leak turns into a destroyed ceiling.
Right.
And ruined hardwood floors and like tens of thousands of dollars in damage that's going to come entirely out of their own bank account.
Exactly. They are highly, highly incentivized to perform preventative maintenance. But once that homeowner secures a comprehensive property policy, that entire incentive structure flips upside down.
Because they get the safety net now.
Right. They might see those exact same curling shingles and think, I should probably patch that eventually. But it's Sunday, the football game is on, and honestly, if a storm hits and water gets in, the insurance will cover the roof replacement and the interior damage.
So they just delay the maintenance.
They delay it. And this brings up a really critical distinction in the formal CPCU definition.
Oh, right. I actually have the exact phrasing here, and I want to read it because it's so specific. The texts define moral hazard as an increase in the probability or severity of loss because insurance reduces the insured's incentive to prevent or minimize losses.
See, that or severity clause, that is doing a lot of heavy lifting.
How do you mean?
Well, think about tossing the smartphone onto the couch. That increases the probability of a loss happening at all, right?
Yeah.
But delaying the roof maintenance, that might not cause the thunderstorm to happen. The storm is just an act of nature. However, the lack of maintenance drastically increases the severity of the loss when that storm finally does hit.
Ah, I see.
What could have been a $200 patch job balloons into a $30,000 massive claim.
So the existence of the safety net was the direct catalyst for the severity of the damage.
Precisely.
When you strip away the moral judgment and just look at it as a mechanical reaction to a changed financial environment, it's actually a pretty fascinating behavioral loop.
It's all about how humans react to risk.
But, if this mindset is constantly lurking, just waiting for a safety net to appear, when does it actually become a tangible problem for the people writing the policies? Like, the chronology here seems incredibly important.
Chronology is everything in risk assessment. If you're analyzing an insurance pool or, sitting for a licensing exam, you have to pinpoint exactly where on the timeline the behavioral shift happens.
Right.
And the absolute unbreakable rule of moral hazard is that it only exists after the insurance coverage is legally in place. It's strictly a post-purchase phenomenon.
So it only happens after you sign the dotted line.
Mm-hmm.
To really cement that timeline, the source material introduces a concept that kind of serves as the chronological mirror image of moral hazard. It seems like you can't really fully grasp what happens after the policy is issued without understanding what happens before.
Yes, you're talking about adverse selection.
Adverse selection, let's dig into that.
Okay, so if moral hazard is the enemy inside the gates, adverse selection is the enemy at the gates.
I love that analogy.
It works, right? Because adverse selection occurs before the policy is purchased. It happens when higher risk individuals actively seek out insurance at a disproportionate rate compared to, lower risk individuals.
Okay, so if I know I'm a terrible driver, I'm going to be the one frantically Googling for the most comprehensive auto insurance I can find.
Exactly. You are self-selecting into the pool because you secretly know your own risk profile better than the insurance company does.
That asymmetry of information.
Right. That asymmetry is the primary driver of adverse selection. The insurance company sets a price based on the assumption of an average driver. But the people who are most eager to buy at that price are the ones who know they're far worse than average.
So the pool of insurers becomes, adversely selected.
Yes, it gets filled with disproportionately high risks before the ink is even dry on the contracts.
Got it. So adverse selection is all about who is buying the policy based on their inherent traits before the transaction even happens. And then moral hazard is about how those people choose to act once the transaction is complete and the coverage is active.
You nailed it. And to illustrate how these two forces interact on a single timeline, the sources actually provide a really detailed case study about a hypothetical driver named John. It maps out his behavior perfectly.
Oh, right. The John case study. Let's walk through John's journey.
Sure. So in the before phase, John lives in a dense urban neighborhood. Car theft, side swipes, vandalism, these are statistically common in his area. And at this point, he has no comprehensive insurance.
Okay, so he's completely on his own.
Right. His incentives are entirely aligned with protecting his own assets.
So he obviously takes proactive measures.
He does. He pays a pretty hefty premium every month to rent a designated spot in a highly secure, locked, well-lit parking garage, and he willingly walks 3 extra blocks in the cold or the rain to get to his apartment.
That's a lot of friction.
It is, but he absorbs that personal inconvenience because the financial protection of his vehicle is paramount, so his behavior is actively depressing his risk of loss.
Then, John decides to buy personal auto insurance. He shops around, and he purchases a comprehensive policy with a very low deductible. The underwriter approves it, the premium is paid, and the policy is officially issued.
Boom! The timeline has now shifted.
We've crossed the threshold.
Exactly. We have crossed the threshold from the before of adverse selection into the after of moral hazard. Now, John's environment hasn't changed at all.
Right. The crime rate in his neighborhood is identical.
The thieves are still out there, but his financial exposure has fundamentally altered.
So he starts doing the mental math on those 3 blocks he walks in the rain every night.
Of course he does. He realizes the inconvenience is no longer worth it. He looks at his budget and decides the monthly fee for the secure garage is, well, an unnecessary expense now.
Because he reads his policy and confirms it covers theft and vandalism.
Right. The insurance will pay anyway. Realization takes hold. So what does he do? He cancels the secure garage. He begins parking his car out on the public street overnight, right in front of his apartment building.
Wow. So he just trades security for convenience, fully aware that the financial burden of like a broken window or a stolen catalytic converter, all of that has been transferred from him to the insurance carrier.
Yes. And mathematically, the actual probability of his car being damaged has just skyrocketed. The only variable that changed in that entire equation was John's behavior. And it changed purely as a reaction to the policy being issued.
That distinction, like adverse selection before, moral hazard after, it is such a clean mental model.
It really is.
And if you're sitting for a CPCU exam,
Yeah.
you really have to draw that timeline in your head. But, I also know that exam writers, especially for courses like the 500, 520, and 530, they love to get into the microscopic weeds.
Oh, they live in the weeds.
Right. So it's not enough to just know the timeline. You have to know precisely how to categorize the specific flavor of the risk.
The hazard spectrum. It's notorious for tripping up students. Because, everyday conversational English uses these words completely interchangeably, but the insurance industry uses them as highly specific diagnostic labels.
The source material breaks this down into the big 3, right? Physical hazard, moral hazard, and morale hazard.
Yes, the big 3.
Let's start with the one that doesn't involve human psychology at all, just to kind of clear it off the board. Physical hazard.
That's the easy one. Physical hazard is observable, it's tangible, and it's objective. It's literally a physical characteristic of the property or the environment that increases the frequency or severity of a loss.
Okay, so like frayed electrical wiring in a 100-year-old building.
Exactly. The wiring doesn't have a mindset. It doesn't care if it's insured or not. It is just objectively more likely to start a fire than, say, brand new copper wiring.
Makes sense.
Other examples would be an intersection with a blind corner increasing the chance of an auto accident, or maybe a commercial freezer with a faulty temperature gauge increasing the chance of food spoilage.
Okay, so physical hazard is straightforward.
Yeah.
But the real trap, like the place where the exams make their money, is the dividing line between moral hazard and morale hazard. M-O-R-A-L-E.
This is where we have to be incredibly precise. Earlier, we established that in general economics, moral hazard is kind of the umbrella term for all behavior changes caused by a safety net.
Right, the general shift.
But in the strict context of CPCU academic categorization, they split hairs over the concept of intent.
Wait, so the exact thing I complained about at the very beginning, that the word moral sounds like it's judging a person's character and intent. That's actually how the textbooks define it.
In these specific texts, yes, actually, the academic definition of moral hazard without the E is strictly limited to an intentional or behavior-related increase in risk. And it's almost always driven by a dishonest or malicious motivation.
So it's the conscious, deliberate act of trying to exploit the insurance policy for profit.
Yes. We are talking about the extreme end of the spectrum here, fraud.
Fraud, got it.
Fraud is the ultimate expression of intentional moral hazard. Think of a struggling business owner purposely setting fire to their own warehouse just to collect the insurance money.
Wow, yeah, arson.
That is arson, and it is absolutely a moral hazard. Or faking a slip and fall injury in a grocery store, staging a multi-car collision, even something like submitting a claim for a stolen television and purposely inflating the value on the police report. In all these cases, the insured is actively orchestrating or exaggerating the loss.
So if moral hazard requires like malicious intent and active orchestration, what is morale hazard?
Morale hazard with the E is the carelessness, the indifference, or just the subconscious relaxation of safety standards, specifically without dishonest intent.
Oh, I see.
It's the classic I don't care, I'm insured attitude.
Okay, so throwing the smartphone onto the couch isn't me trying to commit fraud. Like, I don't want the phone to break. I'm just too lazy to walk over to the table because I know I have a backup plan.
Exactly. Under this strict categorization, throwing the phone is morale hazard. You aren't deliberately trying to smash it to get a payout, which would be moral. You are just being recklessly indifferent to the consequences, which is morale.
And John moving his car from the secure garage to the street.
Also, morale hazard. He's not hoping his car gets stolen, right? He's not colluding with car thieves. He simply values the convenience of street parking more than he fears the risk of theft, purely because the insurance policy cushions the financial blow.
There is a massive flashing warning light in the source material regarding this exact distinction, and it is pure gold for anyone studying for these exams.
Oh, absolutely.
Because the source explicitly points out that outside of the classroom, industry professionals might casually call John's street parking moral hazard. But on the test, you must follow the terminology of the assigned textbook.
That cannot be stressed enough. Let's say a multiple choice question asks you to categorize a homeowner leaving their front door unlocked because they have theft insurance. You have to recognize that there is no malicious intent to defraud the insurer there.
Right.
Therefore, according to the textbook, it is moral hazard. If you pick moral hazard, you get the question wrong.
Let's actually run a few scenarios to really lock this in. I'll give you a hypothetical, and we can debate how it lands on the hazard spectrum.
Let's do it. I love these.
Okay, scenario 1. A restaurant owner is facing bankruptcy. The business is failing. He realizes his commercial property insurance payout would cover all his debts, so he intentionally leaves a deep fryer on high heat after closing, bypasses the safety switch, and goes home, just hoping the building burns down.
All right. That is the textbook definition of moral hazard, no E. It is a deliberate, intentional act designed to cause a loss to collect the insurance money.
Clear fraud. Okay, scenario 2. A different restaurant owner. Business is booming, he's doing great. He recently purchased a massive $2 million umbrella liability policy. Because he feels so heavily protected against lawsuits, he just tells his staff to stop paying for the winter service that salts and clears the ice off the front sidewalk. He figures, hey, if a customer slips, the insurance lawyers will handle it.
That shifts completely to moral hazard. He is not actively trying to break a customer's leg. There's no intent to cause bodily harm for profit. It's just pure carelessness and indifference to safety, born entirely from the comfort of having that liability policy.
So no malicious intent, just negligence. Got it. And scenario 3. The actual sheet of ice forming on the sidewalk.
That is the physical hazard, the tangible environmental condition that objectively increases the likelihood of the slip and fall occurring.
The distinctions are so clear when you apply that filter of intent. It makes perfect sense. But, this brings up a massive question for me. These categorizations are great for passing a test, but how does this actually play out in the real world?
That's the big question.
Because we've established that human beings, when given a safety net, inherently drift toward carelessness or, in extreme cases, fraud. How does a multi-trillion-dollar industry absorb this constant psychological pressure?
They absorb it by building an incredibly complex operational machinery. Moral and morale hazard are not just like theoretical annoyances. They are gravitational forces that basically dictate the daily operations of every major department within an insurance carrier.
Wow.
Yeah, the source material outlines how this ripples through 4 vital pillars: underwriting, pricing, claims, and overall risk management.
Let's start at the front door. Underwriting. I always sort of picture underwriters as the bouncers at the club, deciding who gets in and who doesn't.
They are the ultimate gatekeepers. Their mandate is to evaluate applicants before a policy is issued, which means they are tasked with predicting future behavior.
That sounds impossible.
It's very difficult. They basically have to act as psychological detectives. I mean, it's easy to identify a physical hazard. An underwriter can just order an inspection to see if a roof is failing. But how do you inspect a person's propensity for indifference?
Right, you can't exactly ask them on the application, do you plan on tossing your phone across the room?
Exactly. So underwriters rely on data proxies. They look for historical patterns that strongly correlate with future hazard. For example, many carriers utilize credit-based insurance scores.
Wait, really? Credit scores?
Yes. Statistically, there's a strong correlation between how responsibly a person manages their personal finances and how responsibly they maintain their property or operate a vehicle.
I mean, that kind of makes sense. If you were deeply indifferent to paying your bills on time, you might also be indifferent to changing the brake pads on your car.
Exactly. It's a pattern of behavior. They also heavily scrutinize claims history. If an applicant has filed, say, 6 small, highly avoidable claims in the past 4 years, like a dropped laptop, a minor fender bender in a parking lot, a lost wedding ring that is a screaming red flag for morale hazard.
Oh, because they're treating the insurance like a maintenance plan.
Precisely. It demonstrates a historical pattern of treating the policy as a piggy bank rather than a true safety net for unexpected catastrophes.
So the underwriter's trying to weed out the outright fraudsters, but also desperately trying to filter out the hyper-careless folks.
Yeah.
But what happens when they fail? Or what happens when an entire demographic shifts their behavior? That has to hit the second pillar, right? Pricing.
Pricing is where the theoretical becomes strictly mathematical. Actuarial science is built on the law of large numbers. Actuaries calculate the expected losses for a massive pool of people, and they set the premiums accordingly.
Right.
But if the individuals in that pool suddenly start acting like, abandoning secure parking for the street, the frequency of theft claims will spike way beyond the actuarial predictions.
And if the frequency of claims goes up, the total dollar amount paid out by the carrier goes up.
Which breaks the fundamental equation of insurance. Premiums collected must cover losses paid out, plus administrative expenses, plus a reasonable profit for the capital providers.
So what do?
Well, if morale hazard drives up expected losses, there is only one mathematical solution. Actuaries must increase the premiums for everyone in the pool to cover the shortfall.
Wait, so when my friend leaves their car unlocked at the grocery store because they have insurance, they aren't just risking their own vehicle. Their individual carelessness is mathematically aggregating and directly driving up the cost of my auto insurance premium.
Yes, absolutely. Insurance is a shared financial ecosystem. Moral and morale hazards are system-wide inefficiencies. Every act of carelessness extracts capital from the pool, making the safety net more expensive for every single participant.
That is infuriating, but fascinating. So underwriting tries to stop the careless people from getting in, and pricing tries to mathematically account for the carelessness that slips through. What about the claims department? because they're the ones who show up after the damage is already done.
Right. The claims adjusters are the investigators of the aftermath. Their job is emphatically not to just look at a destroyed kitchen, pull out a checkbook, and ask, how much?
Right. They aren't just an ATM.
Not at all. They have to reconstruct the loss and determine if the coverage actually applies. And a massive part of that investigation is looking for evidence of unmitigated hazard.
Going back to our roof example earlier. The storm blows through, the roof collapses, the kitchen is completely flooded.
So the adjuster gets on site and realizes the underlying roof decking is completely rotted, which indicates a leak that has been ignored for maybe 3 years.
Ah, the neglected maintenance.
Exactly. They are identifying that the severity of this catastrophic loss was directly amplified by the insured's morale hazard, their ongoing indifference to maintenance. Depending on the specific language in the policy contract, a carrier might actually deny the interior water damage claim because the insured failed to take reasonable steps to maintain the property prior to the storm.
Wow. So the claims process is essentially a retroactive audit of the insured's behavior.
It has to be. If claims adjusters just blindly paid every submission, regardless of negligence or fraud, the expected losses would just completely obliterate the pricing models, which would then force premiums so high that underwriting wouldn't be able to sell a single policy. The interconnectedness of these pillars is absolute.
Which leads me to a pretty bleak conclusion here. It sounds like the insurance industry is fighting a perpetual losing war against human nature. Like, if placing a safety net under a human being guarantees they will become careless, how does this entire system not just collapse under its own weight? How do they force us to care again?
That is the domain of the fourth pillar, risk management. The overarching strategy of risk management is recognizing that, look, you cannot change human nature, but you can change the rules of the game.
Okay.
Insurers must find a way to realign the insured's incentives so that they mimic the before state of hypervigilance, even while the policy is active.
But how do you simulate not having insurance while actually providing insurance?
By enforcing a philosophy of shared financial responsibility. The carrier cannot offer a frictionless, unlimited blank check. They just can't. They have to design structural mechanisms within the contract that force the policyholder to maintain skin in the game.
They have to share the pain.
Exactly. They have to share the pain of a loss.
And the most universal tool for inflicting that shared pain has to be the deductible.
Oh, absolutely. The deductible is arguably the single most effective behavioral engineering tool ever devised by the financial sector.
It's that powerful.
It really is. It's a specific dollar amount the insured must pay out of their own pocket before the insurance carrier contributes a single cent to the claim.
You know, I always cynically assumed deductibles existed just because insurance companies were cheap and didn't want to pay for administrative paperwork on a $200 scratch bumper.
I mean, eliminating the administrative burden of microclaims is certainly a massive secondary benefit, but the primary foundational purpose of a deductible is psychological. It is a leash on morale hazard.
Let's do the mental math on this. If John, our hypothetical driver, has a $1,000 deductible on his auto policy and someone smashes his window to steal a $300 radio, the total loss is maybe $800.
And John pays all $800 out of pocket. The insurance company pays nothing because the loss hasn't breached the deductible threshold.
Right.
So knowing this ahead of time, does John cancel his secure garage parking and leave his car on the dark street?
Absolutely not. He realizes that for the vast majority of everyday risks like vandalism, door dings, minor theft, he is functionally uninsured.
Yes. The deductible forces him to retain enough personal financial risk that his incentives remain aligned with loss prevention. He keeps the garage because he is still protecting his own money.
So the deductible successfully re-engineered his behavior. It allowed the carrier to provide a safety net for a total loss, like the car being stolen and never recovered, while forcing John to remain vigilant against partial losses.
Exactly. It's a brilliant mechanism.
That makes total sense for property like a car or a house. But the source material also mentions coinsurance, which I usually associate with health insurance. How does that combat hazard differently than a flat deductible?
Good question. Coinsurance operates on a percentage basis rather than a flat dollar threshold. So instead of paying the first $1,000 and then being fully covered, coinsurance mandates a continuous split of the ongoing costs.
Like an 80-20 split.
Right. A common structure is an 80-20 split, where the carrier pays 80% of the claim and the insured is responsible for 20%.
Why use a percentage? If I have a major medical event or a massive commercial property loss, that 20% could scale into astronomical numbers.
That is exactly the point. See, a flat deductible loses its behavioral power once the loss exceeds the threshold.
Oh, I see where this is going.
Right. If you have a $1,000 deductible and your house is currently suffering $50,000 in fire damage, you've already paid your $1,000. You no longer have a financial incentive to grab a fire extinguisher and try to minimize the remaining damage. The margin of your pain is capped.
Oh, wow. But with the 20% coinsurance clause, every additional dollar of damage costs me 20 cents.
Yes.
So if the medical bill goes from $100,000 to $200,000, my personal out-of-pocket obligation jumps from $20,000 to $40,000.
Exactly. Coinsurance ensures that the insured is continuously financially incentivized to keep the total severity of the loss as low as possible all the way through the event. It forces you to question unnecessary medical tests or, aggressively manage commercial cleanup because you are bleeding financially alongside the carrier.
It's an incredible mechanism to control the severity aspect of morale hazard, which brings us to the third tool, policy limits. This is just the maximum cap the insurance company will pay out, right?
Correct. It is the absolute ceiling of the carrier's liability. If you have a $300,000 limit on your homeowner's liability policy, the carrier will not pay a single dollar beyond that amount.
I mean, I understand why a company needs a limit to protect their own solvency, but how does a ceiling dictate the insured's behavior?
Because it clearly defines the boundaries of the safety net, reminding the insured that the net is not infinite.
Okay, give me an example.
Imagine an individual throwing a massive, reckless party. Fireworks, a trampoline next to a pool, the works. If they believe their insurance provided unlimited liability coverage, there's no boundary to their morale hazard. They would assume the carrier would just handle any lawsuit, no matter how catastrophic.
But if they know their coverage hard stops at $300,000 and a catastrophic injury could result in a $2 million lawsuit,
They realize that for the remaining $1.7 million, their personal assets, their savings, and their future wages are completely exposed. The policy limit forces the insured to retain the ultimate catastrophic risk, which curbs wildly reckless behavior at the extreme margins.
and the final tool in the arsenal seems to be the most blunt instrument of all: exclusions. This is the part of the contract that explicitly lists what is absolutely not covered under any circumstances.
Exclusions are the firm boundaries of the insurance universe. They outline the specific perils or behaviors that the carrier deems just too unpredictable or too susceptible to moral hazard to even attempt to insure.
The most obvious example here has to be the intentional act exclusion.
Oh, without a doubt. Almost every liability policy on Earth excludes coverage for intentional injuries or deliberate property damage caused by the insured. If you intentionally punch someone in the face, your homeowner's liability will not cover the resulting lawsuit.
Because if they covered intentional acts, they would literally be funding criminal behavior. It would be an open invitation for pure moral hazard, with a capital M.
Exactly. Exclusions send a legally binding message to the policyholder. We are stepping away from this specific behavior. We offer zero safety net here. If you choose to engage in this, you bear 100% of the financial and legal consequences alone.
You know, when you lay all these tools out, the deductibles forcing you to handle the small stuff, coinsurance making you share the pain as it scales, limits capping the catastrophic end, and exclusions drawing hard lines in the sand, it completely changes how you view an insurance contract.
It really does.
It's not just a financial product you buy in case something bad happens. It is a highly engineered legal structure purposefully designed to manipulate your behavior.
That is the art and science of underwriting and product development. It is behavioral economics codified into contract law. Every clause, every threshold, and every exclusion is a calculated countermeasure against the inherent human desire to relax when a safety net appears.
I feel like we have traversed a massive amount of conceptual ground today. I mean, from the parking lot anxiety of a new car owner, to the actuarial equations pricing our premiums, to the behavioral engineering hidden in our deductibles. To make sure we synthesize all of this, especially for the CPCU candidates utilizing this as a study companion, let's distill this journey down into the absolute core mechanics.
It is always valuable to summarize the structural foundation.
So at its core, we establish that the mere existence of insurance fundamentally changes how human beings act.
Right.
The safety net inherently reduces our natural, survival-driven incentive to prevent or minimize a loss. It creates a psychological environment where the probability of a loss or the severity of a loss when it happens quantifiably increases.
And we pinpointed the exact moment this gravitational shift occurs. It is strictly a post-purchase phenomenon. The timeline is undeniable.
Right. Before the policy is issued, the carrier is fighting adverse selection, the high-risk individuals rushing the gates. But the moment the policy becomes active, the threat immediately morphs into moral and morale hazard, the internal decay of vigilance.
Beautifully put.
And this isn't just an academic theory. It dictates the operational reality of the entire industry. Underwriters have to act as behavioral profilers to screen it out. Actuaries have to raise everyone's premiums to mathematically absorb it. Claims adjusters have to forensically investigate losses to ensure they aren't paying for unchecked negligence.
And ultimately, risk managers have to design the antidote. They have to build friction back into the system through deductibles, coinsurance, limits, and exclusions, forcing the policyholder to keep enough skin in the game that their incentives remain aligned with the carriers.
Adverse selection before, moral hazard after, friction as the solution. It's an elegant, if slightly cynical, ecosystem.
It is. But before we close out this deep dive, I actually want to pivot away from the textbooks and the exam structures for a moment. I want to offer a thought experiment, something for you to chew on regarding where this ecosystem might be heading in the future.
Oh, I am always here for a good thought experiment. Lay it on me.
We have spent the last hour establishing that friction, the pain of a deductible, the anxiety of a policy limit, the threat of an adjuster denying a claim due to negligence, that friction is the absolute required antidote to keep human carelessness in check. Friction is the load-bearing wall of the insurance industry.
It's the only thing keeping the system solvent.
But look at the modern consumer economy. Look at the tech sector. Every major innovation of the last 20 years has been relentlessly focused on eliminating friction.
Very true.
One-click shopping, instant food delivery, algorithmic content feeds, consumers are being conditioned to expect zero-friction experiences in every single facet of their lives.
Market definitely rewards the path of least resistance.
So imagine a scenario in the near future. A highly capitalized Silicon Valley startup decides to disrupt the legacy insurance industry. They believe the legacy carriers are dinosaurs bogged down by paperwork and adversarial claims processes. So this startup launches a utopian, frictionless insurance product.
Yeah, I'm listening.
Zero deductibles, zero coinsurance, infinite policy limits, and a claims process managed entirely by an AI app that instantly approves and wires money to your account the moment you submit a photo of the damage. No human adjusters asking questions about roof maintenance.
A perfectly frictionless safety net. I mean, that's a consumer's dream.
Right. But my question is, given everything we have discussed today about the realities of human psychology, how quickly does that utopian startup collapse under the sheer, unmitigated weight of its own moral hazard?
Oh, it would be spectacular. Think back to the grocery store parking lot we started with. In a world with zero deductible, infinite limit, frictionless auto insurance, that parking lot wouldn't just be full of people parking a little closer to the carts.
What would it look like?
It would devolve into an absolute demolition derby. People would be bouncing their cars off each other just to get 10 feet closer to the front doors because the app would just instantly wire them the repair money while they were inside buying milk.
Exactly. The behavioral decay would be exponential. Without the structural friction to align incentives, the frequency and severity of losses would skyrocket so rapidly that no actuarial pricing model could ever keep up. The premium required to sustain that pool would become so astronomically high that nobody could afford the policy in the first place.
It's a fascinating paradox. The very friction that consumers hate about insurance, the deductibles, the investigations, the limits, is the only mathematical reason the product can exist at a price they can afford.
The friction is the feature, not the bug.
The friction is the feature. What an incredible way to view the world. I don't think I'll ever look at a grocery store parking lot or a drop smartphone or a $500 deductible the same way again. Thank you for guiding us through the invisible architecture of risk and human nature.
It was my pleasure.
And to everyone listening, thank you for joining us on this deep dive. Whether you are hitting the books to master the CPCU hazard spectrum, or you're just trying to understand why your premiums shift, we hope this conversation has given you a powerful new lens to see the incentives driving the world around you. Best of luck on your exams, stay vigilant out there, and we'll catch you on the next deep dive.